Going public. It's a monumental decision for any private company, isn't
It's
it?
absolutely huge.
On this deep dive, we're aiming to cut through some of that complexity around initial public offerings, IPOs. We've got various sources here, and we'll really dig into what makes this whole process tick.
Exactly. And our goal isn't just, defining terms. It's about giving you a much clearer picture of the key parts, the really crucial steps, and importantly, why they matter when a company thinks about hitting the public markets.
Okay, let's unpack this then.
Yeah.
The mission today, a clearer view of the whole IPO journey, right from those initial thoughts about readiness all the way through to what life is actually like as a public company.
Mm-hmm.
We want to pinpoint those vital factors any company considering this needs to, well, get to grips with. So where does this journey actually begin? What's the real starting point?
Well, it starts way before anyone's even thinking about a ticker symbol. There's a lot of prep work.
Right.
Our sources really stress these vital pre-IPO steps. And a big one, right off the bat, is deeply understanding the business environment. Companies absolutely need to know their market inside out, and crucially, how they stack up against competitors who are already public.
That makes perfect sense.
Yeah.
You can't just leave in without knowing the landscape, can you?
Not at all.
And building on that, I imagine a really solid business strategy is essential.
Foundational.
Yeah.
Trying to go public without a coherent strategy, it's like navigating blindfolded.
Hmm.
And alongside that, companies need to really research the capital markets themselves. What's the general climate like? What are investors looking for right now?
So understanding your own patch and the bigger financial world you're stepping into.
Got it. Now, governance seems to come up again and again as a key area. What are the really critical bits there?
Governance is fundamental.
Hmm.
It's about how the company's run, how it's controlled, and critically how it's going to interact with all its new shareholders.
Right.
So this means taking a hard look at the board of directors. Do they have the right skills, the right experience for a public company?
If you don't have a suitable board, you absolutely need to build one that meets the listing rules of whatever stock exchange you're aiming for.
Okay.
Then there's corporate transparency. How open is the company about things like, say, executive pay? How does it plan to disclose major risks? And a really vital piece is investor relations. You need strategies for talking to shareholders regularly, making voting rights clear, having solid disclosure procedures, and planning how you'll keep them engaged.
So it's not just having a board, it's having the right board and operating really openly. Now, I saw a pretty striking statistic about internal controls. Something like up to 80% of companies need to improve here before an IPO.
That Deloitte figure really jumps out, doesn't it? And
Yeah.
it highlights a massive area. Internal controls are basically the systems that ensure your financial reporting is accurate and transparent.
Sure.
This covers things like record keeping, maybe moving to standard templates, setting up secure ways to manage documents. Lots of private companies just don't have systems built for public scrutiny.
Right. Less formal, maybe.
Exactly. Then financial reporting itself, making sure you're fully compliant with accounting standards like FASB, which is the standard setter for U.S. public companies. Management reporting often needs an upgrade, too. Maybe bringing in audit software for real-time performance data. Tax planning gets even more critical. You need an efficient structure, perfect records.
Sounds intense.
It is. And underpinning it all are information management systems. Think secure data rooms, complete audit trails for handling sensitive info, that 80% figure. It often comes down to private companies having less formal structures that work fine when small, but just can't handle the demands and the microscope of the public markets.
Yeah.
Investors need absolute confidence in the numbers, Weak controls scream higher risk misstatements, maybe even fraud.
That paints a really clear picture of a huge behind-the-scenes job. Just getting those basic systems right sounds like a massive task.
Yeah.
What about the actual day-to-day running of the business? Are there checks there, too?
Oh, absolutely. Again, Deloitte points out over 80% of companies need more resources operationally for an IPO.
80% again. Wow.
Yeah. Financial capability is a big one. Can the company actually afford the IPO process itself? We're talking hefty underwriting fees, listing fees, accounting costs, legal fees. It adds up.
And I read something about ongoing costs being higher than expected, too.
That's right. Over 43% of public companies find those ongoing reporting costs are higher than they budgeted for. It's a continuous expense.
Okay.
Then you've got financing needs, maybe refinancing debt, shoring up working capital, and finally, talent. You need a strong management team, not just to get through the IPO, but to actually lead a public company effectively. Often means bringing in people with specific public market experience.
So it's not enough to have a good idea. You need the operational muscle, the cash, and the right leaders to actually make it work in the public sphere.
Precisely.
So what's the very last step in this whole pre-IPO phase, when all that groundwork is done?
After all that prep, the final step is making contact with underwriters. These are the investment banks that will essentially shepherd the company through the whole process.
All right, the guides. Which takes us neatly into due diligence. We've touched on bits of this, but what specific areas get put under the microscope? That 2025 checklist source seemed quite specific.
It did. It highlights several really key areas. First, the core business model gets a thorough going over.
Naturally.
Investors want to see healthy profit margins, clear growth potential, and that the company really understands its place in the market. And like we said, robust forecast models are vital. Deloitte reckons 80% of companies need to build these out.
Right.
Internal controls obviously get another look to ensure they meet public company standards. Documentation often needs a major overhaul. And finally, legal matters are scrutinized intensely. The legal structure has to be right for a public company. Contracts need to be sound, intellectual property protected, licenses all in order.
So a complete health check of the entire business, from economics to legal standing. And that checklist also mentioned specific documents they look at, didn't it?
Oh yeah, everything. Years of audited financials, recent unaudited ones, detailed management discussion and analysis, the MD&A section, tax returns, lists of assets, liabilities, all key contracts, customer, supplier, employee, property, loans, you name it.
Wow.
Plus the detailed business plan, market analysis, and even what they call the equity story, that compelling narrative you need to attract investors.
Okay, so the company has been thoroughly vetted, deemed ready. Now the investment banks really step up. What's their main role in all this?
Essentially, they're the bridge. They connect the company that wants to sell shares with the investors who might want to buy them. They're the experienced guides through what can be a really complex maze.
And what are the key things they actually do? Sounds like a lot falls on their shoulders.
It does. A huge part is doing their own due diligence. They need to check everything themselves. Profitability, legal status, financials, market potential. Their reputation is on the line too, you know. Then comes underwriting. That's basically them helping the company sell those first shares to the public. There are different ways they can arrange this, but the core job is facilitating the sale.
Okay.
This is all formalized in an engagement letter, and the bank gets paid through the gross spread or underwriting discount, typically around 7% of the total money raised.
7%, that's quite a chunk.
It is. It reflects the work and the risk involved for them.
So beyond just selling shares, what else are they handling?
Documentation is massive. They help prepare the registration statement, that huge document filed with the regulators, like the SEC in the US. It has everything. Company info, financials, management backgrounds, who owns what, legal issues, the proposed ticker symbol. And a key part of that is the prospectus. That's the comprehensive info booklet for potential investors. They also play a vital role in pricing the shares. Our sources don't detail the exact methods, but the bank's expertise is key to finding that sweet spot for the initial price, aiming for strong demand.
Right, getting the price right is critical.
Absolutely. Then there's marketing. They run pre-marketing efforts, organize road shows where management pitches to big investors to gauge interest and estimate demand.
Okay.
After the IPO, they might do some stabilization, basically buying shares in the market for a short time if needed to support the price. And finally, they often help shape the company's ongoing investor relations strategy, planning for earnings calls, regular updates, keeping those new shareholders informed.
Sounds like end-to-end support, really, even after the launch. How does a company pick the right bank? Must be a big decision.
It is. Several things matter. The bank's reputation, their track record with IPOs, the quality of their research analysts is important for attracting investors.
Makes sense.
Specific industry expertise is huge. A bank that understands your sector adds a lot of value. Their distribution network, how well can they reach the right investors? That's critical. And sometimes just existing relationships play a part.
Okay, so we've got the prepared company, the investment bank. Let's get into some specific IPO mechanics. The green shoe option, that sounds interesting. What's that all about?
The green shoe, or over-allotment option, yeah, it's a pretty neat mechanism, actually. It's designed to help manage the stock's trading right after the IPO.
How so?
It's basically a clause in the underwriting agreement that lets the underwriters sell more shares up to an extra 15% than originally planned, but only if investor demand is super high.
Ah, like a buffer for unexpected popularity. What's the main point of having it?
Exactly. It's primarily about promoting price stability in those first few volatile days or weeks. It helps add liquidity and generally supports the stock price. And interestingly, it's the only price stabilization method the SEC actually permits.
So how do the banks use it? Does it work if the price goes up or down?
It does. If the IPO is a big hit and the price jumps up, they can exercise the option, buy those extra shares from the company at the original IPO price, and sell them into the market at the higher price. Nice bit of profit for them. But if the price starts to fall below the IPO price, they can use that green shoe short position differently. They can buy shares back in the open market to cover their position. That buying activity helps create demand and can stabilize the falling price.
Clever. So it helps smooth things out either way.
Yeah.
And there were different types mentioned. Full, partial.
Yeah, full just means they use the entire 15% extra. Partial means they use some but not all of it. A reverse green shoe is less common, where they might return unsold over allotted shares.
Understood.
Okay.
Okay, the million-dollar question, or maybe multi-million. How is that initial IPO price actually set? It's not just plucked out of thin air, right?
Definitely not. But our source on valuation makes an important point. IPO valuation isn't always about starting from scratch and valuing the whole company anew.
Oh, how does it work then?
Often, it's more about taking the company's pre-IPO valuation and adjusting it for the public market. For example, maybe removing a discount that was applied because it was private and illiquid.
Okay, so building on what's already understood about its worth,
Yeah.
what factors go into that adjustment and the final price?
Well, they often start by thinking about how much money the company actually wants to raise. Then they look hard at comparable public companies, similar industry, size, growth, and their valuation multiples, like maybe their price-to-earnings ratio looking 1 year ahead.
Right, benchmarking.
Exactly. They also distinguish between primary shares, new ones the company creates to raise capital for itself, and secondary shares, which are existing shares being sold by early investors or founders.
Ah, so primary cash for the company, secondary cash for existing shareholders.
Precisely. Primary shares mean the proceeds go onto the company's balance sheet. Secondary shares are often VCs, founders, early employees cashing out some of their stake.
Got it.
And the green shoe fits in here too, usually allowing for more primary shares, that extra 15% or so if demand is really strong. The actual cash the company gets, the net proceeds, is the total offering size minus all the fees, like that big underwriting discount we mentioned.
And can the story around a company, the narrative, the hype, actually affect the valuation? Thinking back to the dot-com era.
Oh, absolutely. The source highlights that a really compelling corporate narrative, a great story, truly groundbreaking products, can definitely boost the valuation, even for companies without much revenue yet, like some of those 90s internet firms.
Presumably with a health warning.
Yes, definitely exercise caution with overly hyped stories. A good narrative gets attention, but investors still need to kick the tires and check the financial fundamentals underneath. The numbers still have to stack up eventually.
Wise words. Okay, two other quick mechanisms. Lockup period and quiet period. What are those?
Right. The lockup period is basically an agreement stopping company insiders, employees, early investors from selling their shares for a set time right after the IPO, often 90 to 180 days.
Why? To stop the price crashing.
Exactly. It prevents a sudden flood of selling pressure hitting the market right away. The quiet period is typically a 25-day window after the IPO. During this time, the company and underwriters shift from the legally required disclosures in the prospectus to the normal flow of market info. After it ends, the underwriters can start publishing research reports with earnings estimates and valuations.
Okay, makes sense. Let's shift focus to the rules, the regulatory side. IPOs are obviously heavily regulated. We hear about the SEC in the US, but what's the picture like in the UK?
Yeah, the UK has its own Shikari robust regulatory framework. A key first decision for a UK company is where to list the London Stock Exchange as the main player, of course. Now, Brexit has had an impact. The current rules for the prospectus, that key investor document, are based on the EU prospectus regulation that was brought into UK law. But things are changing.
Oh, what's happened?
A whole new UK prospectus regime is expected, probably landing in 2025. This is driven by new legislation, the Financial Services and Markets Act 2023, and new rules coming from the regulator, the Financial Conduct Authority, or FCA.
And what kind of changes might we see with this new UK regime?
Well, several things are on the table, possibly changes to how long the prospectus summary can be, maybe more flexibility around disclosing working capital statements, definitely more focus on sustainability disclosures. ESG is huge now.
Right.
They might raise the thresholds for when secondary share issues need a full prospectus. There's talk of a potentially less strict liability regime for forward-looking statements and prospectuses, which could be significant, and maybe new ways to offer shares to the public, like through specific regulated platforms.
Sounds like potentially quite a shakeup for UK IPOs. What about the actual listing rules themselves?
The FCA has reviewed those too. They're moving towards a single main category for equity shares, commercial companies, getting rid of the old premium and standard listing distinction.
Simpler, maybe?
Hopefully. If you list on the main market in this new category, you need a sponsor, an approved investment bank, to guide you on the rules and confirm you're suitable. If you list on AIM, the alternative investment market, you have a nominated advisor or NOMAD doing a similar job ongoing.
Okay.
And the prospectus for the main market or the admission document for AIM is still that key disclosure document. Plus, once you are public in the UK, there are ongoing obligations, regular financial reports, good investor relations, and complying with rules like UK MRR, the market abuse regulation, to prevent things like insider dealing.
And they check the prospectus carefully.
Oh, yes. There's a verification process in the UK where statements in the prospectus have to be backed up by underlying documents. It's rigorous.
Clearly a very detailed environment. So thinking about the IPO market overall, is it always busy? Always a good time to go public?
Not at all. IPO markets are famously cyclical. You get hot periods, then cooler periods.
Boom and bust.
Sort of, yeah. Companies often try to time their IPO for when the market's hot, but our sources rightly caution against relying too much on timing. A strong company with good fundamentals should succeed regardless, eventually. Market timing is tricky.
And how is the market looking now, sort of early 2025? Are things booming or less so?
Well, there seem to be a few headwinds people are talking about, maybe a bit of a hangover from the post-COVID boom in companies issuing shares, especially some of those SPACs that haven't done so well.
Ah, the SPAC hangover.
Could be part of it. Also, the regulatory burden just keeps increasing, direct costs, legal fees, ongoing reporting. It makes going public more expensive and complex.
Right.
Plus, you've got these huge private asset managers now with tons of capital. They offer an alternative funding route, so maybe some companies feel less pressure to go public for cash.
Interesting.
And then there's always near-term uncertainty, politics, the economy that can make companies cautious.
Yeah.
But there's also some cautious optimism. Yeah, the feeling is that maybe some higher quality companies will come to market, especially ones backed by private equity firms looking for an exit as their investments mature.
And we hear about alternatives like direct listings and SPACs. Can you quickly explain those?
Sure. Direct listings like Spotify and Palantir did let a company list its shares without a traditional underwritten offering to raise new capital. It gives more control, and the price is set by the market on day one.
Okay.
SPACs, special purpose acquisition companies, are basically shell companies that IPO first to raise cash, then look for a private company to merge with and take public that way. It used to be seen as a potentially faster, sometimes less regulated route, though that's tightened up a bit.
Got it. And any other big trends shaping IPOs right now?
Definitely seeing technology playing a bigger role. Things like virtual roadshows are common now. And as we mentioned, ESG, environmental, social, governance factors are massively important for investors now. Companies really have to have their stories straight on that front.
Okay, we've covered the journey, the mechanics, the rules, the market. Let's boil it down. For a private company thinking about this, what are the big pros and cons of going public?
The potential upsides are pretty significant. First, raising serious capital money for operations, growth, R&D, buying other companies.
The main reason for many, I guess.
Often, yes. Second, public shares usually get a higher valuation because they're liquid, easier to buy and sell. Third, having public stock gives you a currency for doing M&A deals.
Right.
Fourth, it creates liquidity for early investors and founders and exit route. Fifth, it boosts the company's profile, credibility, brand recognition. And sixth, it generally improves access to capital markets for future funding needs.
Those all sound pretty attractive. But what about the downsides? What are the trade-offs companies need to be ready for?
There are definitely major downsides. The costs, as we've said, underwriting, legal, accounting, listing fees, they're significant. Big upfront expense. Then there's the intense public scrutiny. You have to disclose detailed financials, strategic information to everyone, including competitors. That loss of privacy is huge.
Yeah, that must be a big adjustment.
It is. There's also immense pressure to meet short-term market expectations, quarterly earnings, profits. That can sometimes pull focus away from vital long-term
The
plans.
tyranny of the quarterlies.
Exactly. Existing shareholders also face dilution. Their ownership percentage goes down. And finally, the ongoing burden of regulatory compliance and reporting is heavy, costly, and time-consuming. That public scrutiny means everything is out there. Quarterly reports, significant event disclosures, potentially giving competitors insights they never had before.
It really does sound like a major balancing act.
Eh?
Opportunities versus responsibilities. So what happens after the IPO? The shares are trading, the champagne's been popped.
Hmm.
What's life like then?
Life definitely changes. It's not the end, it's new beginning with different pressures. Employee roles often become even more critical under that public spotlight.
Also,
Well, everyone needs to understand how their work contributes to meeting those public expectations. Management teams often find they spend way more time on investor relations talking to analysts, shareholders.
right, a whole new set of stakeholders to manage.
Absolutely. And it's vital everyone in the company understands their part in keeping the ship steady as a public entity. Then there are the ongoing reporting duties to the regulators like the SEC quarterly reports, annual reports, filings for significant events. It's continuous.
So constant communication and compliance.
Pretty much. Effective, transparent communication with shareholders and the investment community via investor relations programs is absolutely key. And just staying on top of all the reporting, disclosure, and governance rules is essential to keep investor confidence and stay out of trouble.
So the IPO isn't the finish line at all. It's more like the starting gun for a different kind of race.
That's a great way to put it. It's a massive milestone, sure, but building long-term value as a public company, that takes constant effort, adapting, and a real commitment to being open and accountable.
Well, this has been incredibly insightful. A really deep look into the IPO world. It's so clear it's profoundly complex, isn't it?
Absolutely. It really demands meticulous preparation across the board, careful thought about so many different factors from business basics to complex regulations to shifting market moods.
And as we've discussed, while it offers these huge opportunities growth, capital, it brings equally significant responsibilities and that constant scrutiny.
So for any of you listening whose companies might be thinking about this, hopefully our chat today highlights just how vital it is to do your homework really thoroughly and critically get expert legal and financial advice involved early on.
Definitely sounds like essential advice. And just to leave you with something to mull over.
Yeah.
Thinking about this evolving IPO landscape, new rules, these alternative routes like direct listings, changing investor priorities like ESG, what do you think might be the single biggest shift we see in how companies choose to tap into public money over the next 10 years or so?
That's a fascinating question.
Something to ponder. Thanks for joining us for this deep dive.